This is John Carter, Senior Editor for Political Economy at the South China Morning Post. Today we're talking to Yasuyuki Sawada, Chief Economist of the Asian Development Bank. Sawada-san,
Yes.
Today you released an update of your main Asian development outlook, which is fairly optimistic about the outlook for Asian growth despite the trade war. Could you explain the main conclusions of your report?
Yes. Actually, our position is, we can say, cautionary optimistic. We are optimistic, as you said, in terms of maintaining 6.0% growth this year for Asia. We made in April, maintain this time updated, in spite of seemingly escalating trade tensions between China and the U.S. Actually, so far, we see sound domestic demand of Asian economies, consumption demand is quite strong, and also investment, both public, private, is strong. So these factors seems to maintain our 6.0% growth rate this year. However, next year, because of this more than expected escalation of trade tension between U.S. and China, and that seems to generate especially a negative impact on Chinese economy. So that's why we downward revised our next year's forecast from 5.9% to 5.8%, 0.1 percentage point revision. So in this sense, we are cautious, but probably we are leaning towards a more optimistic side.
Indeed. You left your forecast for China this year unchanged at 6.6%. And reduced your expectation for Chinese growth next year only slightly to 6.3 from 6.4%. Still more than double major developed countries. Clearly, you see only a slight impact from the trade war.
That's right. That's right.
Could you explain why, please?
That's right. The current level of trade measures adopted by U.S. and also counter measures, employed by the China side, $50 billion plus 200 billion US trade tariff measures on U.S. side, and the retaliation of China is 50 billion plus 60 billion. And we did some quantitative assessment using our data, and direct impact will be export from China will slow down because of tariff, 25% tariff imposed on 250 or so billion export from China to the U.S. But this level of tariff cost, if we compare overall Chinese export, which is only less than 1%. So direct impact is negative, but indeed the magnitude seems to be negligible. Rather small. And of course, direct sector directly affected by tariff measures will generate a spillover effect through a supply chain network within China. And again, we did estimate what's the likely consequences. And overall, direct indirect impact seems to be rather limited. So that's why we incorporated the negative impact, but the magnitude seems to be smaller. So that's why we slightly downward revised the Chinese growth next year, 6.4% to 6.3%.
You also expect Chinese government policies meant to stabilize growth to be largely successful, both fiscal and monetary policy?
Yeah, that's right. China already started adopting a more accommodative monetary policy to stimulate economy, and also there is a sign of employing expansionary fiscal policy to stimulate economy. So these are proactive response by Chinese government seems to maintain growth momentum of China.
Your report also warns that if the U.S. carries out its threat to sanction all Chinese imports into the U.S., another 267 billion of goods, then it would have a greater impact on China and Asia. Could you explain?
Yes. Again, using our unique data, and actually in detail, we use so-called input-output data, which covers 90% of the global economy, and also sector-specific information included. So we can see, one sector affecting another, so intersectoral linkages using this input-output data. But using this data, we can fully quantify what's the direct impact and also indirect impact arising through a supply chain network within China. So this escalation scenario, all the U.S. and Chinese export and imports goods and services face a 25% tariff measures. In this setting, direct and indirect impact on Chinese export to the U.S. and Chinese production level, we see a 1 percentage point decline of Chinese GDP, not confined to the 1 year, but spread it over a few years. So this is the level of consequences we obtain through a quantified analysis.
Okay. But you also see, in addition to a slight negative impact on China, you also see a slight positive impact on the rest of Asia.
That's right.
Could you tell us why that is?
In fact, in addition to direct impact on slowing down Chinese export or countries' export to the U.S., and also associated indirect impact through a supply chain network, we can see another third effects of tariff measure change, which is that because Chinese export to U.S. slow down in particular sector, so other countries affected directly by U.S. Tariff measures can potentially fulfill this unmet demand generated by this bilateral trade tariff measures. So that's why some of the Asian countries, according to our data analysis, can receive a rather positive overall impact, mainly due to this directed trade effects, and especially NIES, newly industrialized economies of four tigers, and also some ASEAN countries can gain, especially those countries producing similar products as the Chinese exports to the U.S., notably electricity sector production, and also in the case of ASEAN countries, textile and garment sectors seem to receive a positive trade redirection effects.
Sawada-san, thank you very much for your time.
Thank you very much, John.
Yeah.